Hi, good day, guys. My name is Nick, technical analyst with Zitrodex, and today we're looking at the analysis on the currency pair GBP USD. And first, we're talking about fundamental analysis. Then we move right down to technicals, which will be purely what will be seen on the chart, involving a lot of support and resistance levels, involving slide down, involving trend line building, and a lot more things, momentum, price action to kick in with. So first of all, we have to understand fundamentally that the pound to dollar week ahead, that GBP USD strikes 4-month best amid US recession fears. And let's say Morgan Stanley considers that a huge German fiscal boost will boost the euro and serve as a catalyst to weaken the dollar as the case for US exceptionalism phase. Now, the pound to dollar exchange rate has already hit 4-month highs above 1.29, and the bank expects the pound will take further advantage with further gains to 1.33. Now, on a short-term view, Morgan Stanley expects that there will be phase of consolidation as the euro is in overbought territory following the recent surge with the dollar at a 4-month low. Now, longer term, we're expecting, however, that the bank will consider that the German U-turn on fiscal policy is a game changer, while Germany has proposed a Euro 500 billion infrastructure fund as well as substantial increase in defending spending. Right now, in isolation, Morgan Stanley considers some notes the package is impressive with both the growth outlook. It also considers there will be an important psychological impact. Now, dollar gained strong capital inflows over the past few years, and in part some because investors struggle to find a viable alternative. The German bazooka, however, could be crucial in shifting the narrative, with Europe seen as much more attractive and dragging capital away from the US. Now, the bank remains broadly positive on the pound, especially if risk appetite can improve, although global developments will continue to dominate. At the time of writing, GBP USD is currently trading and at 1.2922, having retreated slightly from its 4-month high, but it's still up in a whooping 2.6% on the week. And of course, the United States dollar pegging has plummeted to a multi-month lows last week amidst growing fears that the US tariffs and retaliatory measures could tip the American economy into a recession. And this led to immediate retaliation from all the three countries. Now, the prospect of the US entering trade wars with its three largest trading partners raised some fears that the US economy could contract over the coming years. And this in turn has fueled bets on more interest rate cut for the Federal Reserve amidst a struggling US economy. And Friday brought no respite for the US dollar as the latest non-farm payrolls report missed forecast. And we are expecting that the pound, of course, following this, will enjoy some success early in the week amidst hopes that Europe-led peace plan could end the war in Ukraine. Nevertheless, the GBP was still able to post impressive gains against the dollar, with the American currency facing such a dramatic reprising. Looking forward, the latest US consumer price index is in focus. So with all that being said and done, we can understand basically that expecting a free fall down to 1.28631. And this is about, let's say, 200 pips from that point. And once it gets to this resistance, or support rather, it will definitely have a bounce to the upside a bit before we know where exactly the market is going to be heading to, all based on the fundamental news events. So if you're getting your sellers ready, I think, yes, of course, it's a good idea for the short time down to 1.28645, and then we secure from profit. And that's our technical analysis on today's currency pair GBP USD. I remain your host, Nick. Bye for now.